Say that we are having a banner year. Our weekly lunch program is enjoying great attendance. We have a rich diversity of speakers that reflect the wonderful intellectual diversity in our field. But today we come to one of our two major events of the year, our summer signature program. And I need to thank two friends, two sponsors who have made today's great event worthwhile. First of all, my friends at Inforum. Inforum is a research and consulting firm that's been open for 52 years and very much embodies the great tradition of innovative economic research at the University of Maryland. Secondly, our friends at the National Association of Realtors. Since 1908, they have been the voice of the real estate community in Washington and have provided some invaluable economic data, economic research in that critical sector of the economy. With that in mind, with those organizations supporting us and with this large and distinguished audience behind us, we've come to a moment. And I have to tell you, I cannot imagine a better marriage of a moment and a speaker than what we have today. Hey, Jim Bullard is really a man who embodies the best of our field. One of the joys of doing this, and of course it's a hassle putting together an event like this, but one of the joys of doing this is not just to introduce a speaker, but to really think about what makes that person unique. Jim has used economic theory, high-level economic theory, to powerfully propel the thinking of the Federal Reserve forward in a way that's going to benefit all Americans, that is benefiting all Americans. At the same time, he is very much integral and a man of his community. He's a man of the people who are affected by his policies. He is, of course, the president and CEO of the St. Louis Federal Reserve. He also oversees the Federal Reserve's 8th district, including activities at St. Louis Headquarters and its branches in Little Rock, Arkansas, Louisville, Kentucky, and Memphis, Tennessee. I actually didn't realize it had that many branches. He's a noted economist and scholar. Every time he publishes a paper, I think the thinking on the FOMC moves forward. Early in his tenure, Bullard talked about the possibility of a Japanese-style deflation in a paper. He argued strongly for something that may seem like common sense, but I've never heard before, that FOMC deliberations shouldn't be out by the calendar, but by data, but by the need. During the financial crisis, he advocated for inflation targeting, something that very well may have saved a lot of us. But he's an active member in his community. He sits on the Board of Trustees of the United Way, the Board of Directors of the St. Louis Regional Chamber, and the Board of Directors of the Concurrence Academy in Leadership, and a list of other things that we simply don't have time to get into. He's a native of Lake Forest, Minnesota. He received his doctorate in economics from Indiana University in Bloomington and holds a Bachelor of Science degree in economics and quantitative methods and information systems from St. Cloud University in St. Cloud, Minnesota. Now, let me tell you how our program is going to work today. President Bullard is going to speak. After that, my colleague Ed Keene is going to do an interview with him. Ed is a noted economic correspondent, a long-time Federal Reserve expert, and a past president of the National Economists Club. After that, we're going to spend some time taking audience questions. We ask respectfully, because President Bullard's time is limited, that you keep your questions concise, and we will do your best to sort of address them respectfully. For now, President Bullard, we are grateful for your time. We are very aware of the weightiness of the moment, and we look forward to your insights. Ladies and gentlemen, Jim Bullard.
Gosh, what a great introduction. I think I'll just sit down. because it can only be downhill from here. But no, I do appreciate the opportunity to be here at the National Press Club and in front of the NEC. And I'm looking forward to hearing your comments on current monetary policy or whatever else you want to talk about the U.S. economy. So I call this a sea change in U.S. monetary policy. So hopefully I can convince you of the dramatic changes that have already occurred in 2019 with respect to U.S. monetary policy above and far beyond the rate cut that we had just last week. So if you don't want to listen to the whole talk, you can just read this slide. We made significant changes in monetary policy, of which many of you are aware, beginning in January of this year. Those changes were made in anticipation of slower growth in the U.S. economy during 2019, which is materializing. I'll talk about that during the talk here, but also in anticipation of heightened uncertainty with respect to trade policy. So I think we anticipated the idea that trade policy was going to be volatile currently and going forward across the forecast horizon. I think we could do more at this point, but we've also already done a lot, and so what I'd like to do is take some stock of what we've already done and see how that impacts the economy and then make decisions going forward. So that's my main point here in the third bullet point, and we'll talk about that in detail, maybe too much detail as I go through this talk. In the meantime, inflation pressures certainly are muted in the U.S. economy. I'll talk a little bit about that. We've also got yield curve issues, which I think are still with us. So we're looking for those to get better as we go through the rest of this year and into 2020. So let me just talk about this argument about a sea change in U.S. monetary policy and review what has happened since late 2018 when this story begins. In 2018, the interest rate environment was obviously much different than it is right now, and that's my point, I guess, to the extent I have one. I do have one. I want you to focus on just the two-year yield, two-year Treasury yield, because the two-year Treasury yield embodies both the current level of the policy rate, but also the immediate outlook for the policy rate. And if you look at the two-year yield as of November, early November last year, it was almost 3% in round numbers. And the 10-year Treasury was trading to yield about 3.25%. So it was a very different interest rate environment, but the 3% on the two-year reflected the fact that the policy rate had been increasing through 2017 and 2018, and that the committee was projecting further increases in 2019 and 2020, and we still had a positive spread between the two-year and the 10-year. So that was the situation at the beginning of the story. We raised the policy rate at the December meeting and projected further increases in 2019, but then the story began to change with Chair Powell's comments at the American Economics Association meetings in Atlanta on January 4th, and gradually through the first 6 months of 2019, the committee started to project less and less in the way of policy rate increases. We also put together a plan to cease the runoff of the balance sheet, which is now fully being implemented as of our last meeting's decision. We did not change the policy rate at the June 19th meeting, but we strongly suggested that rate reduction was forthcoming. And at the meeting that we just had last week, we went ahead and followed through on that rate reduction. So then the main point here is that the whole interest rate structure is dramatically lower given this sea change. And if you look at the two-year Treasury, it was trading to yield about 1.75%. That would be a decline of almost 125 basis points from the early November reading. So I'm pushing back against people, maybe some of you, who said, oh, the 25 basis points, that's not enough in this environment, and boy, that's a small change, and that's not going to move anything. No, that isn't the way to read this. There's been a sea change in monetary policy, a very large movement, which I would characterize by this change in the 2-year, because not only has the level of the policy rate changed, but the outlook for the policy rate has changed. And that's what the 2-year is kind of telling you. It's combining those two things together. So 125 basis points lower in the 2-year, 10-year trading to yield, I guess 186 on August 2nd. Things are moving quickly here. 186 on August 2nd. But even today, the 2-year, 10-year spread is still positive. That's because markets are probably expecting more action from the committee. But the point is that the structure of short-term rates dropped by about 125 basis points due to FOMC action. The longer-term rates fell in tandem, so most of the time we would, when we're describing this to clients and customers, we would say that's the longer-term rates are more important for investment decisions, but this was a case where the longer-term rate came down in tandem with the short rate, and so here we're providing more monetary policy accommodation than we did late last year. So bottom line, U.S. monetary policy quite a bit more accommodative than it was. Furthermore, let's all channel our inner Milton Friedman here. There are long and variable lags in the effect of monetary policy on the economy. So these are developments that just happened over the last 6 months or so. You wouldn't expect them to show up in the macroeconomic data right away, but I would expect them to begin to show up in the second half of 2019, about where we are now, or later this year, and the first half of 2020. That's when I would think that the maximum impact of this sea change in monetary policy would occur. So I think here's a picture that shows this whole, the whole sequence of events here. You guys have this picture etched in your mind anyway, so you know this, but it goes to November 8th, 2018, on the first vertical line, all the way up to the June 19th decision. And again, the June 19th decision, we didn't actually lower the policy rate, but we sent a very strong signal that we were going to lower the policy rate at the next meeting, which we followed through with on July 31st. So I wouldn't necessarily say that, well, the right things didn't happen after the July 31st meeting. That decision was effectively made more or less at the June 19th meeting. But anyway, no matter how you want to look at this, this is a big change in U.S. monetary policy. Now, let me talk about some of the conditions that drove this. I think the biggest one is probably just that, as we have been anticipating for a long time, the U.S. economy would probably slow down to its potential growth rate. We're talking about an economy that's growing at an above potential rate of growth. The natural thing, and I'm sure you're all predicting it too, is that it will probably slow down to the potential growth rate going forward. The revised figures on GDP have the economy growing at 2.5% in 2018. 2019 growth has been expected to be slower, although I will hold out a little bit of idea that maybe 2019 won't be worse than 2018 as far as growth. I think there's some potential, it's not my base case, but some potential for growth to be 2.5% again, or even a little better in 2019. So we'll see if that holds up or not. Part of that might come from more accommodative monetary policy, as I've described it. But we've had this key risk on the horizon, and all of you have been coping with this too, is that trade uncertainties might cause the natural slowdown to be sharper than anticipated, and you'd get something skirting around 1% growth or something like that. So here's a picture. I love this picture, so I'm going to dwell on it for a while. This is a picture of starting in March 2017 and continuing out over the forecast horizon. This is the U.S. real GDP growth rate, but it's measured from 1 year earlier, so it's smoothed out a bit compared to the way we usually look at it. The blue line is the actual data. That dotted line on the left-hand side is the March 2017 FOMC projection for GDP growth. So what did the FOMC think in the first half of 2017? And probably many of you thought, oh, the economy is going to grow at 2% as far as the eye can see. But that isn't what and then on the right-hand side, there the dots and the dotted line are the current SEP projections from where we are today. So you can see the blue line obviously ratcheted up quite a bit during 2017 and 2018. The year-over-year growth rate did breach 3% middle of last year and third quarter of last year. Year-over-year growth rate has been declining since then, as predicted, and as we would have all expected that growth would come back to the potential growth rate. And the dotted line on the right says that it's expected to continue to decline down back to the potential growth rate. But boy, look at the upside surprise compared to March 2017 about how much more growth we got in the U.S. economy than what was expected as of that time. That was the upside surprise. And on the right-hand side is the expected slowdown. So the risk here is that the blue line goes down more than you think, and possibly because of trade uncertainty. And that's why I think the Fed has taken out some insurance against that possibility by providing a more accommodative monetary policy over the last 6 months. So it certainly seems, based on recent developments, that it will be very hard to get a stable trade regime environment over the near term or over the forecast horizon, which I would describe as 2 to 3 years. I think there's no question that this is chilling global investment and slowing the global growth rate. That seems to be factored into almost everyone's forecast. If you feed trade restrictions into a model, you will get out and that the trade restrictions' direct effects are probably small, but there can be other knock-on effects, mostly coming through financial markets and other sources that can be much larger. So there's some risk here and some uncertainty here about what the effects of this increased trade uncertainty will be. I would stress this. We're in a tit-for-tat trade war, and it is not, in any tit-for-tat trade war, each side is going to make threats and counter-threats at any point in time. These might be daily, they might be weekly, they might be monthly, but the nature of a tit-for-tat trade war is that there's threats and counter-threats occurring all the time. Some of these might be implemented, some of these might not actually ever get implemented. But the nature of the war is that you have tit-for-tat going on all the time. It is not reasonable for monetary policy to respond to all these threats and counter-threats. If you did that, you'd get a very volatile monetary policy, and you'd be contributing to the volatility that's being caused by the trade war in the first place. So I don't think that's the right way to think about how monetary policy can take this situation into account. I want to think instead of trade regime uncertainty as simply being high. It's just high, and it's going to be high for the foreseeable future because it's going to be very hard for the various sides to repair trust and to get back to a stable trade regime over the forecast horizon. So we've already taken that into account. Trade regime uncertainty is high, and we're putting that into the monetary policy calculus. We've eased monetary policy in reaction to that through the accommodation that I described earlier. Particular threats and counter-threats are not news because that's part of the way the uncertainty plays out over time in a tit-for-tat trade war. And I'm not expecting this uncertainty to go away. But we've already tried to take out some insurance against the possible damage that the trade war could do to the U.S. economy. So here's a picture. This uses the Baker-Blumen-Davis measure of policy uncertainty with respect to trade. It was low, 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 high. That's how I read this picture. So it was low all through the 2000s or even before that. I would describe the post-war as the U.S. leading the drive to trade liberalization that culminated in the entry of China into the WTO in 2001. And since then, a fairly stable trade regime with reasonable certainty about what the trading arrangements were going to be and what the tariff arrangements were going to be, but that has exploded since trade has become a much bigger political issue. I would say not just in the United States, not just in the Republican Party or this administration, both political parties in the U.S. and politics all around the world now questioning global trade arrangements. That's why I don't think this is going to go away. You've opened Pandora's box. These are very difficult issues. You're not going to be able to put them back in the box. So we're going to have trade regime uncertainty as described on the right-hand side of this chart for as far as the eye can see. And like I say, I mean, from our point of view as monetary policymakers, we have to take that into account, which we've already done. And we bought some insurance against the deleterious effects that this might have on economic growth. Okay, we have other concerns, meanwhile, that are bubbling in the background. One of them is muted inflation. We have a 2% inflation target in the U.S. We measure this as PCE inflation, headline inflation. A lot of times we'll look at core inflation to get an idea of some kind of underlying gauge of inflation pressure. Both inflation and inflation expectations are below target. I think this is surprising because this is occurring despite the upside surprise in the economy that I described earlier, which has been ongoing from 2017, 2018, and even the first half of 2019. All of that period has been above potential growth in the U.S. economy, stellar performance of labor markets in the U.S. economy, and nevertheless, our core PCE inflation measure from 1 year ago is only 1.6%. So I think this is a concern. We'd like to see inflation at or even above target in this environment. Here's a picture. I'm experimenting here with the Cleveland Fed's 2-year expected inflation measure, minus 30 basis points because that expected inflation measure is on CPI inflation, so to translate it over to PCE inflation, subtracted 30 basis points. And theory tells you the expected inflation over a short horizon like that should correspond to actual inflation pretty tightly, and that does appear to correspond pretty tightly in this picture. And they're both below target. Both expected inflation and actual inflation are below target at 1.5, 1.6, 1.4% range. So why aren't we seeing more inflation pressure? I think that's a great question for the committee. This is something I'd like to see us be able to move back toward target more quickly, and hopefully our accommodation is helping us do that. Let me just touch on yield curve issues, and then I'll conclude, and we'll start our I guess I get grilled twice here. I first get grilled by Ed, then by all of you. So on the yield curve does contain important information for monetary policymakers. I have talked a lot about yield curve inversion. It has tended to predict the onset of recession. However, there is a big lag between the inversion and whatever else might actually happen, so that's something to keep in mind on this. You do have some inversion today because the 10-year is trading below the 3-month yield or the federal funds rate, so that is concerning. But the 2-year 10-year is not inverted at this point because the 2-year is taking into account likely future actions of the committee. So I would say that's a mitigating factor in my mind. We're not seeing an intensification of yield curve inversion so far, based on partly on anticipated future policy from the Fed. So I don't think this has gotten any worse here. Here's a picture, various spreads. They've got the 10-year, 2-year there, which I've labeled as still positive. The others have inverted, but only slightly. Some of that's gotten worse just in the last day or so. So I am concerned about this issue. I would like to see a healthier upward sloping yield curve. If you look at the second half of the 1990s, where the Fed made policy adjustments in the 95-96 period to find the right level of the policy rate, then the yield curve was upward sloping all through the second half of the 1990s, one of the best periods of economic performance in the post-war era. And the slope averaged, 50 basis points, 100 basis points during that period. And I'd like to get back to some, this is all too flat for my taste here. But with the accommodation that's coming on board, if we see inflation start to pick up and inflation expectations start to pick up, you might get a more natural slope to the yield curve, and we'd be in better shape if that happened. So let me conclude. The FOMC continues to face a slowing economy, a naturally slowing economy, I would say, with some risk from trade regime uncertainty. We have an inflation rate that continues to fall short, both in actual inflation and expected inflation continues to fall short of our 2% target. On the other hand, we also have a lot of accommodation that's just now coming on board from the first half of the sea change in monetary policy during the first half of 2019. That should push inflation back to target faster or maybe even above target over the forecast horizon. It's possible that we could take additional action, but I do want to see how the effects of our previous actions play out in the economy going forward before we make those decisions. So thanks very much. You guys have been very kind to have me here today. I'm looking forward to your questions. So thank you.
Okay. Everybody hear me okay? Okay, good. Okay. All right. Well, thanks, Jim, for doing this. We really appreciate it. So I'm going to first start off by talking about some of the trade issues that you highlighted. So since the interest rate decision last week, we've seen some, I guess, re-intensification of some of the trade tensions that have gone on throughout the year. Does this re-intensification, does this affect how you're seeing the economic outlook? Are you marking down your forecast at all as a result of not only the announcement of additional tariffs, but also the financial market reaction to that announcement?
Well, I do think that the trade regime uncertainty, it became clear earlier this year, I think especially became clear that trade regime uncertainty was just going to be high. And I would regard, you say intensification, but I would say a manifestation of trade regime uncertainty just in the last few days. So you would certainly expect, if you're going to be in a tit-for-tat trade war, that the two sides are going to be trading barbs and threats and trying to get the other side to come to the table and do all kinds of things. That's maybe natural in a negotiating setting, but I would not describe that as intensification. That's just ongoing trade war. That's the nature of the trade war. In my mind anyway, we've already adjusted for the fact that this is going to be, trade regime uncertainty is going to be high. We've put in a more accommodative policy. Now it's time to see if we bought enough insurance against the possible negative effects of this policy.
Okay. One other aspect of the announcement last week was that this next round of tariffs against imports from China, a lot of this will apply to consumer goods, whereas until now, a lot of this has been, the tariffs have been applied against intermediate inputs. Do you see that changing the dynamic at all of how you think about the likely effects of this on the economy?
Well, like I said, if you put tariffs into a macroeconomic model and change them, what you'll get is relatively small effects, macroeconomic effects. So to the extent there are large effects, and there may be, I think they're going to come in, for instance, global manufacturing, and the global manufacturing PMI has declined into negative territory. U.S. manufacturers are scrambling to reorient their supply chains. It seems to me that, and it's chilling global investment because investors aren't sure where to invest that'll give them shelter from the ongoing trade war. So I think those kinds of effects might be bigger than the effects directly on consumers. Consumers certainly aren't going to sit idly by and pay higher prices. They're probably going to shift part of that to other substitute goods. That's the kind of thing that happens inside a model. and kind of mitigates some of these effects. There would be some effects depending on what the goods are that we're talking about, but I'm not sure I would go from the idea that they're being applied to consumer goods to automatically assume that that's a very large effect on the U.S. economy.
Okay. So last week, Chair Powell described the interest rate cut as an adjustment, and then went on to suggest that that the Fed was not currently anticipating a very long series of rate cuts, and yet financial markets still appear to be anticipating considerable further easing. When I looked this morning, it was about the Fed funds futures market was implying about another percentage point of cuts. How do those expectations square with your overall economic outlook? And what would you need, and to get that amount of easing, what kind of outcomes would you need to see?
Yeah, I think I'll give you my take on the idea of a mid-course correction. If you look at the 1995 experience, in 94 we raised the policy rate, and early 95 we raised the policy rate 300 basis points in a single year. It was the worst year for bond markets of the post-war era, I believe. Then later in 1995 and early 1996, the committee struggled to find exactly the right level for the policy rate. It looked like the economy was slowing down a lot in the first half of 1995 based on real-time data. The committee ended up adjusting down slightly, got to the right rate, and set up the economy for a great second half of the 1990s. So I hope we can pull that off here. We've raised the policy rate during 2017, 2018, not 300 basis points, but maybe 225 basis points. So it's a similar normalization. Obviously, the level of rates is way lower, but that's kind of global trends in interest rates. And now what you'd like to do, now that you've finished the normalization, is see if we can find the right level of the policy rate. So I think that's how I would think of this, as a mid-cycle correction. Like I say, we've already put a lot of, the outlook for monetary policy has changed dramatically in the last 6 months. So you've got a lot of implicit accommodation coming back to the economy that should affect us in the second half of 2019 and the first half of 2020. It's not clear that you want to pile on necessarily at this juncture. You want to see how those previous moves are affecting the economy, but I wouldn't rule out more changes ahead. So this is how I'm thinking about it. I do not predict recession on the horizon here, and so I don't think we're in a situation where you have to, you're not in recession mode here, you're in mid-cycle. That's why I like the mid-cycle language. But you still want to find the right level of interest rates for this environment. Hopefully it'll set us up to continue the expansion for many more years to come.
Okay. One other question on the policy outlook. So in the run-up to this last meeting, there was a fair bit of debate about whether the cut should be 25, a quarter-point cut or a half-point cut. And I know at one point you suggested that going to a half-point cut would probably be somewhat overdone. In thinking about the question of the size of any cuts, to do something like a half-point cut, which tends to be pretty aggressive, what would you need to see to do something like that? Because when I look at the financial market pricing, there's still some element of risk perceived for a half-point cut.
Well, you can look historically at episodes where the committee has moved with that kind of, made that kind of a move. I don't really see us as being in a situation where that was true. One that I can think of is, off the top of my head, is late 2007, early 2008. Mm-hmm. So there you had really the financial crisis had started in earnest on August 9th and 10th, 2007. The committee had done a lot of things during the fall. Then we got some worse data right around that time period. The committee met out of cycle and actually lowered the policy rate dramatically in the first part of 2008. We're not in that situation. I mean, come on, the economy is growing at above potential rate. It has been for the last 2.5 years. The labor markets are super, unemployment at near a 50-year low. So I think there are a lot of good things going on in the economy, even though you've got risks out there, as we always do. But I don't think we're in a situation where you really have to be quite as dramatic as a cut like that would suggest.
Okay. Okay, so in your speech, you touched upon the low inflation environment, inflation being below target. So we've had a situation in recent years, and this is something that's affected other central banks as well, where notwithstanding strong growth and tight labor markets, inflation's been below 2%. Do you see structural factors that are in place that are likely to keep inflation suppressed? And if so, does that limit the ability of the Fed and other central banks to try to get inflation back up to target?
Yeah, I think this is an interesting hypothesis. I certainly read about it a lot. I'm not sure I have a real solid theory in my head about this, but it certainly does seem like technology has become a lot more important somehow as a fraction of the economy. And what do we know about technology prices? They tend to drop over time, and so somehow that's feeding into the inflation process. I think it's not unusual if you disaggregate, you guys know better than I do, but if it's not unusual if you disaggregate inflation numbers to see prices, relative trends in all kinds of different prices. Medical prices are a good example. Technology prices are a good example. Housing prices, housing rents are a good example. So it seems like the overall price level is going up at this nice constant rate, but that does not mean that all these subsectors are going up at the same rate, because relative prices are changing over long-run trends over time. And if one of those trends becomes more important, then that could have this disinflationary impact. But I would hesitate to say I've really been able to nail that down in a way that's really convincing.
Okay.
And so I'd stop there with that.
Okay. Also following up on the question about inflation, so the Fed is undergoing now a strategy review, and there have been suggestions made on how to enhance the credibility of the inflation target. There's been talk of moving to average inflation targeting, price level targeting. Other ideas have come up. What are your thoughts on these on those?
Yeah, those that are interested, you might check out the Chicago conference that we had on framework issues. I think it's all available online. But you also might check out the conference that occurred a month before that at Stanford University. There, I actually gave one of the many presentations, and you can check out what I said. It was about nominal GDP targeting as a possible framework going forward. I think you should think about evolution rather than revolution in the Fed's policy framework. I think there are a lot of ideas that are related to price level targeting, because price level targeting in a lot of different models turns out to be the best thing that you can do. And so I think those ideas about trying to make up for past misses on the inflation rate and try to, if you missed on the low side for a while, then you might miss on the high side in the future, or vice versa. That tends to work well, at least inside models, and so that kind of thinking is becoming more prevalent across central banks around the world, and I think will eventually carry the day. But again, I think it's more evolution than all of a sudden you wake up one day and the Fed has radically changed its framework. I don't think that's going to happen. It's very hard to get these things to move. So I think there will be maybe some movement in that direction, at least implicitly, coming out of this framework review.
Okay, so I think one more question before we turn to the audience, and this relates to the question of the Fed's independence. Earlier today, 4 former Federal Reserve chairs wrote an article in the Wall Street Journal touting the need for Fed independence. We've seen situations now where the executive branch has been more directly critical, at least for a number of years that I can remember, about the Fed's decision-making. Is there any concern on your part that the public's confidence in the independence of the Fed is at risk from what's happening here.
Well, I certainly appreciated the former chairs coming out with the op-ed. I thought it was great. So even though they're retired and we quit paying them, they're still working, and I appreciate that. So I think my reading of the editorial was it was just reiterating why American monetary policy is set up the way it is, because there were all these lessons learned from earlier eras when it didn't work out so well, especially the 1970s. And because of that, we made the changes that we did. I think it works pretty well. You've got this very large technocratic committee. You've got lots of viewpoints that are expressed. You have to get the committee to somehow center. I think the committee makes better decisions as a committee than any one individual member would, so there is a wisdom by having the committee structure. And I think we're really just making decisions the way we always have. We look at the data on the economy, make a judgment, and go ahead. So it's true that there's maybe more buzz around this than there was, but I don't know. My experience in the Fed is that there's always a debate going on. There's always people talking about what the FOMC should do. I'm so used to it that I like it. I like getting input from all different angles and all different directions. But then the committee sits down and goes ahead and makes a decision. I think it's working pretty well.
Okay. All right, I think we'll open it up for questions. Okay, why don't we go over here and then over here next? Okay, go ahead. If you could state your name, affiliation, and ask your question in the form of a question, no speeches.
Lawrence Yun, National Association of Realtors. The component of the CPI where it is accelerating is on the housing component, apartment rents, owner equivalency rent. That is due to the housing shortage. And the home builders, especially the small-size builders who have been relying on construction loan from local community banks, that has dried up. I'm not sure if it's loosening up any bit, but the lack of housing start is causing housing shortage as well as accelerating in housing rent. Is there anything that regional president can do to stimulate the lending of construction loan to the small-time builders?
Yeah, I think the market obviously was shaken by the crisis. We're 10 years past that now. I think the reaction to it seemed to be, you can tell me more probably, but the reaction to it seemed to be to build more multifamily and less single family. Some of the numbers that I see suggest plenty of multifamily. Also, tastes seem to have changed to some degree as newly formed households maybe aren't as eager to get into a house as they would have been historically. And because of that, I think builders have pulled back a little bit. So we're not trying to, I'm certainly not trying to limit community bank exposure to housing, but I think this has been somewhat of a market response as opposed to a policy response.
Go right here.
I'm Ed Weiler. I'm a retired federal government economist. I have a question. I want to pick up on your thing about the disaggregated price series you're talking about. What about asset prices, asset inflation? There seems to be stocks, bonds, et cetera, that is driving a lot of market activity, and that doesn't seem to factor into any of this conversation we've had about whether or not we have inflation. Can you speak to that?
Yeah, there's a long-standing debate, which certainly goes back into the 1990s and probably well before that, as to whether you should include asset prices in the measure of the standard of living or the cost of living. I think the answer to that is no. I think the asset prices are something else, but you could certainly make that case, and certainly economists have made that case over time. I don't think, as a general rule, I don't think it behooves us to try to react to stock prices, let's say equity prices, with monetary policy. I think it's a kind of a losing game to get involved in that. The market moves around very rapidly. reprices every day by 1% or something. I think the wisdom has been that the market is trying to assess the future of the U.S. economy and the global economy, but the Fed is also trying to assess the future of the U.S. economy and the global economy. If they start trying to assess each other, then you get into a circular movement. So I think it's better to just think about the goods and services prices that the consumers actually pay.
Gentleman in the back.
Stanley Kober. One of the things that's puzzled me is the low inflation is global. Central bankers around the world have been spiking the punch bowl with everything they can get their hands on, and nobody's getting even the slightest bit tipsy. One of the reasons I've begun explaining this is that too low for too long is affecting the solvency of a lot of lending institutions, and they are cutting back. Could that be an explanation? And in that case, at what point does the situation turn from too low being stimulative to being restrictive?
Yeah, I think it's a very provocative point. Global inflation is low, so if you added up all the central banks of the world and made them into just one central bank, that central bank is somehow targeting a very low interest rate, which is just the opposite of the 1970s. In the 1970s, obviously inflation got to double-digit levels in the US, but it was also global inflation. Globally, inflation was very high all around the world. So the unified central bank of the world had too high of an inflation target and didn't keep inflation under control. So, but to put together models of exactly how that works, take into account exchange rates and many other features of the global environment is just beyond, I think, what we can do. You do have a big player, China, which is managing to the US dollar, and so typically what you would think is that China is importing US monetary policy because they're managing to the dollar. That's keeping inflation low in China. Whereas in other circumstances, you would think a big developing economy like that would be contributing to global inflation, but instead inflation is pretty low in China. So, so there are many things to consider here. I'm not sure we have great models of how this all works.
Hi, Hyman Arbon, U.S. Bureau of Labor Statistics. Some economists have argued that the issues the Fed is facing in monetary policy have to do with a change in framework, in the sense that the Fed funds is no longer the main driver for monetary policy decisions, but rather the interest paid on excess reserves. And also the change from a corridor system of monetary policy to a floor system of monetary policy. Can you maybe address that?
Yeah, one thing that you might check out is we have a series of blogs at the St. Louis Fed that have talked about repo facility to complement the reverse repo facility that we have. We think that that would be a good idea. It might have some benefits to how we operate monetary policy. So this is something that may be gaining some traction at the Fed, and I think could serve us well going forward. But as far as the impact of monetary policy on rates, I think it's pretty clear that we're still influencing the short end of the curve very dramatically, and some would say too much or too far out the curve. But I think there's no question that the very short-term yields that are market-based are very closely tied to actual policy. So I think that part is working the same as it always has.
Hi, Elliot Schatzman. What are your feelings about student debt right now, which seems to be out of control, and how that might impact the economy in the future? I have a son that's going to be starting Indiana University in 2 weeks.
Yes.
So, exactly.
Go Hoosiers.
So as student debt continues to grow, how do you factor that in down the road? Rates on student debt are ridiculous too. 11, 12%.
Yeah, I'd like to see reform of the student debt situation. I think it is it's getting out of control. I do not like the idea of lending to a prospective student who really shouldn't be taking the money based on the degree that they might be getting and will not be able to repay it because they're still going to be stuck. You can garnish their wages and stuff, so they're going to be stuck with this for a long time. I think there should be some process around that initial disbursement. I don't know about you guys. When I got my student loan, there was hardly any questions asked at all because it was a guaranteed student loan. There was no questions asked, and I could have been a good student. I could have been a crappy student. They didn't really check. So I think that this has become a more concerning situation. It's very ripe for reform. Also, I don't see why these can't be just market-determined rates instead of legislatively determined rates. So I'd like to see some movement on this. This has been going on too long.
Is there any mechanism in place that's being looked at to do some of those things?
I don't know, when I talk to people on Capitol Hill, they do talk about this issue, but I don't see anything happening, so.
Susan Irving from the Government Accountability Office. We seem to be in almost a worldwide negative interest rate regime, or we're heading that way. So what does that, I mean, at some point there will be another recession. It seems to me, what does that imply for the ability of monetary policy to be a useful tool in that situation?
Yeah, I think it's a great point, and one of the successes of monetary policy during the Powell era is that we've been able to normalize rates as much as we have. I know it's not as much as other people might have been looking for, but we have been able to move off the zero bound. We've been able to get the policy rate up somewhat, and I think that will help us if we do get into a recessionary situation. We'll have some ability to react to that. Other countries haven't been able to do that, notably Japan and Europe. And so when they go back into recession, they're going to have less ability to react to that. And they're going to have to use unconventional policies, which are more tenuous in their effects on the economy.
Pat Lawler. Notwithstanding all the other reasons for lowering interest rates, you talked a bit about the shape of the yield curve as a reason. You did recognize that the Fed has some effect on that in that people may be anticipating future Fed actions, but potentially one of the dynamics could have to do with the Fed's change in its portfolio runoff decisions, that it was running them off and built up a set of expectations and then took them away, and so you have both the announcement of that and then the actual fact of it, or the dawning realization of it, as well as the fact that you've never been in this kind of a situation where you've run this stuff off and changed the rules. Do you think that could have had any effect on the changes in the yield curve that we've seen?
Yeah, I guess when I'm thinking about the yield curve at a kind of practical level, there are also a lot of models out there, and they're not so practical, but let's just think about it that the Fed has a lot of influence at the short end of the curve, and the market has a lot of influence at the long end of the curve. I think that's the kind of traditional monetary policy thinking. It's true that there's been really global QE, and because of that, people have said that the longer rates are lower. If you look at the empirical evidence on that, the magnitude of that effect is not so large, and should be dissipating because various countries around the world have stopped doing the QE part. Also, it was all priced in initially, so now as it gets unwound, it should be going the other way. Yield should be going up. I'm not really seeing that aspect of it. So I think I would like to see a more upward sloping yield curve. It strikes me that the kinds of levels on the 10-year that are talked about today are low, certainly at the low end of the trading range over the last 5 years. So I would expect with a little more inflation, a little more expected inflation, we'll probably see a more upward sloping yield curve going forward, but we'll have to see if that develops or not.
I think there was a question over here.
Alan Schlafer. What is the impact on current and future monetary policy in terms of the Chinese devaluation, its potential impact in offsetting possible price increases in consumer goods, plus the higher savings rate in the U.S. economy and wages in this country now exceeding the rate of inflation?
I would say it looks to me, just looking at the last few days here, that the Chinese, correct me if I'm wrong, they did not fix above the 7 level. They fixed below, right? So it seems to me that the policy has not changed, that they want to contain, they do want to contain the exchange rate movements in the same range that they had before. I think that makes sense because it's their policy, and that was their policy, and I don't think that they're going to change the exchange rate policy in reaction to the trade threats coming from the U.S., because the whole reason they had that policy is they wanted to provide some stability for the Chinese economy. So I'm not sure that I would expect them to abandon that policy in this situation. Well, we'll see, you know. Maybe they would, but it seems to me the fact that they tried to fix under 7 suggests that they're returning to the policy that they had before. That's how I'd interpret current events.
Okay, I think I'm going to take the moderator's prerogative to ask the last question.
Okay.
So in your remarks, you stressed that this trade policy uncertainty is going to remain with us for quite a while. Does that have implications going forward as to what we should think of as the equilibrium level for interest rates?
Probably, if anything, it would moderate interest rates slightly compared to what you would otherwise have. So I would think that'd be a factor. How big that factor really is compared to everything else that's going on in the global economy is a good question. And so we're going to have to monitor the situation, keep track of it going forward. So,
I'm just going to close things out here a bit. First of all, President Bullard, we have a gift for you. It's an expression of our gratitude. Thank you for helping us make. On behalf of me, my team, and our members, thank you for making our summer event a very exciting one.
it's a model.
We think it'll appreciate 5 to 10% a year. I'd like to thank my colleague Ed Keene, did a wonderful job to the NEC team. To our members, we will be announcing our big annual dinner soon, the programs for the fall, some other things coming. We're going to have a new website. You'll hear about that soon. For now, ladies and gentlemen, thank you for coming. Have a good afternoon.